In November of 2022, $8 billion disappeared in just 72 hours. Not from a hack or a breach or a theft by outsiders, not from a market crash or a sudden collapse in token prices. From customer accounts that showed full balances on screen the entire time. The customers could see their money sitting there in their FTX accounts. They just couldn't withdraw it when they tried to take it out, because it had already been spent on bets they never knew about. The company was valued at $32 billion 9 months earlier. Tom Brady did the commercials during football games every single Sunday last year. Larry David did the Super Bowl ad, mocking people who doubted new technology. Sam Bankman-Fried appeared on magazine covers wearing cargo shorts and messy hair. He talked about effective altruism and donating most of his wealth someday. The message to customers was simple and clear. Crypto was finally safe. FTX had adult supervision and regulation and audits and real financial controls. Except absolutely none of that turned out to be true at all. For 3 years, FTX told customers their money was held separately and safely. The interface looked clean, and the balances updated, and everything seemed normal. But behind the scenes, there was no separation between customer funds at all. When you deposited money into FTX, the system did show you a balance. That balance looked exactly like your money sitting in your personal FTX account. But it wasn't actually held separately from anyone else's deposits in the system. It went into one giant pool mixed with everyone else's deposits completely. And that pool had a backdoor that only one company could access. FTX had a sister company called Alameda Research, run by the same people. Alameda was a trading firm that made big leveraged bets on crypto tokens. And Alameda had special access to the customer pool that nobody else had. It could borrow billions from FTX customer deposits without posting any collateral at all. No margin calls if the bets went bad. No limits on size whatsoever. No separation between customer money and money used for risky trading bets daily. Alameda would take customer deposits and use them for massive leveraged token bets. When those bets won, Alameda kept every dollar of the profit for itself. When those bets lost badly, the loss stayed hidden on FTX's books instead. The customers never saw it reflected in their account balances on screen. This wasn't a temporary arrangement or an emergency measure during a crisis period. It was built into the system from the very beginning on purpose intentionally. Bankman-Fried coded special exemptions for Alameda into the FTX software from day one. Alameda had a negative balance limit of negative $65 billion total. That means it could owe FTX $65 billion before any alarm went off. No other customer had anything close to that kind of borrowing power ever. Most customers had standard margin limits based on their account size and collateral, but Alameda could take essentially unlimited funds with zero collateral posted at all. And nobody outside a small circle in the Bahamas knew this arrangement existed. Let's walk through 3 specific moments when this system started falling apart badly. May 2022, the Terra Luna stablecoin collapses and wipes out $40 billion. Alameda had massive exposure to Luna tokens and lost somewhere near $3 billion. FTX customers saw no change at all in their displayed account balances, because those losses weren't actually theirs, even though it was their money gone. The hole was just hidden in the accounting that customers never saw. Bankman-Fried later testified he thought the losses were around $1.7 billion. But internal documents suggested the number was closer to $3 billion total. Either way, it was customer money from FTX used for Alameda's bets completely. And the customers had no idea their deposits were funding these risky trades. June 2022, crypto lender Voyager Digital files for bankruptcy and markets drop further. Alameda's token positions keep losing value as the entire crypto market falls. More customer deposits get used to cover Alameda's margin calls on other exchanges. The hole grows larger, but FTX keeps operating normally and accepting new deposits. New customers open accounts and deposit money that immediately goes to cover old losses. This is the classic structure of a Ponzi scheme, even if unintentional. New money pays for old obligations, while the underlying hole keeps growing silently. September 2022. Crypto prices keep falling, and Alameda's positions keep losing more money. By this point, Alameda owed FTX more than $8 billion in total. That's $8 billion taken from customer deposits and lost on bad token bets. Still, no customer knew anything was wrong because balances still looked completely normal. Employees at FTX headquarters in the Bahamas kept working on new features daily. They launched new products and new tokens and new marketing campaigns every week. Nobody told them that the company was insolvent and missing billions of dollars. Only Bankman-Fried and a few top executives knew the true financial situation. And they kept spending money on sponsorships and real estate and celebrity deals. FTX bought the naming rights to the Miami Heat Arena for 19 years. They paid $200 million for a stadium name that lasted 1 year. They spent hundreds of millions on ads with Tom Brady and Steph Curry, all while owing $8 billion to customers who had no idea whatsoever. November 2022, a leaked balance sheet shows Alameda's assets are mostly FTX tokens. Not real money or stable assets, but tokens created by FTX itself, essentially. A reporter from CoinDesk publishes the leak, and customers start asking uncomfortable questions. The balance sheet showed Alameda held $14 billion in assets on paper, but $5 billion of that was FTT tokens, which FTX had created itself, and $3.6 billion was other crypto tokens that Alameda couldn't sell quickly. So the actual liquid assets were much smaller than the liabilities owed back. Changpeng Zhao, who runs Binance, the largest crypto exchange, tweets he's selling FTT. He says Binance will liquidate all its FTT holdings worth around $500 million. This creates panic because if FTT price drops, Alameda's collateral becomes worthless instantly. Within 48 hours, customers try to withdraw $6 billion all at once. FTX doesn't have it because it was already spent and lost long ago. The company tries to raise emergency funding from other firms, but nobody will help. Binance briefly considers buying FTX, but walks away after seeing the actual books. The hole is too big and too messy and involves too much fraud. The company freezes withdrawals and files for bankruptcy within the same week completely. Customers log in and see their balances but can't access a single dollar. One customer had $600,000 shown in his account on screen. He'd been saving for years to buy a house for his family someday. That balance never changed, but the money was gone, spent on Alameda's bad bets. Another customer had her entire retirement savings sitting in FTX shown as safe. She was 62 years old and planning to retire in 2 years. The money showed up on her screen, but she'll likely never see it. A third customer deposited money on a Monday, withdrew successfully on Tuesday, felt safe, then deposited much more on Wednesday and got locked out by Friday morning. The system looked exactly the same both days, but the liquidity was gone. A couple in Singapore had their wedding fund locked in FTX accounts completely. They were supposed to get married in 3 months and had saved carefully. Now, that money is frozen in bankruptcy court and might never come back. A small business owner kept his company's cash reserves in FTX for yield. He thought it was safer than keeping it in a regular bank account. Now his business can't make payroll and he's considering shutting down operations. These aren't gamblers or day traders, or people chasing quick, risky gains. These are regular people who believed FTX was a safe place for money. Here's what makes this different from a normal bank run or failure. Banks lend your deposits out, but they follow rules about capital and reserves. They're required to hold certain percentages and face audits and regulatory examinations constantly. The FDIC insures deposits up to $250,000 per account. And banks can't just wire money to a sister company with no oversight. FTX had none of that, because crypto exchanges aren't regulated like actual banks. Bankman-Fried could move money between FTX and Alameda with no oversight whatsoever. He didn't need board approval or regulatory permission or even basic internal controls. The backdoor existed because he built it himself into the code initially. Alameda's borrowing didn't show up in FTX customer accounts or public financial statements. It was invisible to customers and invisible to most employees at FTX. Only a small group of people in the Bahamas knew the true state. And they kept building and spending and betting as if nothing was wrong. FTX bought stadium naming rights for $200 million over 19 years. They spent hundreds of millions on celebrity endorsements and Super Bowl commercials and sponsorships. They bought luxury penthouses in the Bahamas where executives all lived together. They threw parties and hired hundreds of new employees with high salaries, all while the hole in customer funds kept growing larger every single month. The human behavior pattern here is something called normalcy bias in stressful situations. When systems look normal on the surface, people assume everything underneath is fine. The FTX interface looked professional, and the balances updated, and the company seemed stable. So customers didn't question whether their money was actually there or not, really. The website worked smoothly, and customer service responded, and withdrawals processed for months. Everything seemed fine, until the moment it suddenly wasn't fine at all. And when things started going wrong, the people inside convinced themselves it was temporary. Bankman-Fried reportedly believed crypto prices would recover and fix the hole eventually somehow. He kept spending and kept borrowing because he thought growth would solve everything. He told employees the company was fine and the concerns were overblown nonsense. Even as the hole grew to $8 billion, he believed it could work. That's the same pattern that appears in almost every major financial collapse historically. The belief that you can grow your way out of a solvency problem. You can't grow out of already spending money that doesn't belong to you. Lehman Brothers believed it in 2008 until they collapsed in days. Enron believed it in 2001 until the fraud became too obvious. Every Ponzi scheme operator believes the market will turn and save them eventually. It never does because the math doesn't work and the hole keeps growing. Here's the reframe that changes how you see exchange risk going forward permanently. When your money sits in an exchange account, it's not actually your money anymore. It's a claim on the exchange, a promise that you can withdraw someday. That promise is only as good as the exchange's actual liquidity and honesty. You can't verify their liquidity and you can't audit their honesty as a customer. You can only see the balance number on a screen that might mean nothing. The FTX customers who withdrew their money in October 2022 got it out safely. The customers who waited until November saw the same balances but got nothing. The difference wasn't luck. It was understanding that displayed balances aren't actual possession. This is why the phrase, "not your keys, not your coins," exists in crypto. If you don't control the private keys, you don't actually control the funds. You're trusting someone else to hold them and hoping they're honest and solvent. That trust worked fine for FTX customers until the day it suddenly didn't. And when it broke, there was no insurance and no government backstop at all. The bankruptcy process is still ongoing and customers might recover 30 cents per dollar. Maybe 50 cents if they're lucky and the lawyers don't take too much. But that money they saw on screen in November 2022 is gone forever. It was spent on bad bets and real estate and commercials years ago. The lesson isn't that crypto is bad or that exchanges are all fraudulent. The lesson is that middlemen create risk even when they look safe and professional. FTX looked safer than almost any other crypto exchange for 3 straight years. It had the branding and the celebrity endorsements and the venture capital backing. Sequoia Capital invested in FTX and wrote glowing articles about Bankman-Fried's vision. They described him as a genius and a future trillionaire who would change finance. That article has since been deleted from their website after the collapse happened. And it still spent $8 billion of customer money without anyone noticing, because the system allowed it and the incentives encouraged it and nobody checked. If you keep money in any exchange, only keep what you're willing to lose. Not what you think you might lose, but what you can afford to lose. Because the difference between a balance on screen and actual possession is everything. And that difference can disappear in 72 hours with no warning signs. The people who lost money in FTX weren't stupid or careless or reckless. They were trusting a system that looked legitimate and professional and safe. They made the same choice millions of people make with banks every day. The only difference is banks have regulations and insurance, and FTX didn't. Welcome to Luxona, the Netflix of finance, where we explain how money works.